Hello everybody. Sorry, it took me a second to find my unmute button. Welcome to today's event on GST and the margin scheme. So today is actually part one of a two-part series with Tax Nuggets Academy on the margin scheme. Tomorrow's session is a focus on the calculation aspect of the margin scheme. So today we're just going to go through the eligibility to use it. So this event is brought to you live by Tax Nuggets Academy. I'm Vicky and I'm your host for today. So today we have, I think, over 700 registrants. So it's going to be pretty epic and I think quite busy in the chat box and the Q&A. If this is your first time coming to a Tax Nuggets Academy session, welcome, welcome. It's great to have you with us and hopefully you have a great time. If you're already a Nuggeteer or subscriber with us, welcome back. Thanks for joining us today. So as usual, the chats are open. I'll just do a little bit of housekeeping while we're waiting for more people to come through the door because it is a pretty big crowd, like I said, today. So just running through some key things, just some housekeeping for the session. You can ask questions via the Q&A box. Oh, someone's already popped something in there. So that's better for me if you pop your questions in there because we might not be able to handle everything in the session, but we do have some Q&A time at the end where our lovely instructor, Ken, might be able to answer all that we've got for us. And then secondly, you can pop any comments and banter in the chat. A lot of people already say hello there too. So hello. Nice to see everybody here today. And lastly, participate. So if you do have questions or if you do need some clarification on something, don't quite get it, happy to go through things again. Just let us know because I'll be keeping a lookout in the Q&A box in case anyone needs any clarifications. And as usual, the session is being recorded and replays are available for our VIP and team subscribers. So if you need to dip, you do need to be on those subscription plans to access the webinar again. As well, for those who aren't existing Nuggeteers, so like the people who are in for the freebie session today, we don't send out certificates for attendance, but they are recorded in the log, automatic CPD logging. That's one of our key features. So if you want to sign up for a free trial as well, that gives you like 10 days access our library, as well as your CPD log if you need that for your end of year renewals for your professional associations. Just a little bit about us. So for those who are new, I'm the head of learning here at Tax Nuggets Academy, just pulling the strings behind the scenes, getting all our presentations pretty and nice and getting our instructors stage ready. And we're a subscription-based all-you-can-eat platform like Netflix. So if you're sick of watching Bridgerton for whatever reason, you can come to Tax Nuggets Academy and learn a bit about tax, hopefully in a very fun way. So you get unlimited access to all of our live events. So we do a couple a week. So you can, pick whatever you want to learn about. We have monthly tax updates. We have different topics like this one throughout the year. And if you're on the VIP or team subscription plans, then you get replays to all of our previous events, as well as access to resources that you can download anytime. So this also includes structured programs like our Zero to Mini here that for those who have attended, I was also the host for that, as well as our recently finished FBT program, as well as the monthly tax updates that I've mentioned before. So our instructors are leading practitioners, just like the one I'm about to present to you, Ken Fehily. So he's Mr. GST himself. They teach real world skills and not just really super boring lecture-y kind of stuff. And you also get your on-demand CPD reporting. Like I mentioned, everything that you watch or attend is automatically logged for you, so you don't need to get spammed with CPD certificates all the time. And we don't do lock-in contracts, so we are a pay monthly, cancel anytime platform, even if you are on our team plan. So if you're curious to dive a bit deeper and maybe join the Nuggeteer community, you can head over to our website or just Google us if you can't be bothered clicking the link and check us out. So without further ado, please welcome our superstar instructor for today, Mr. Ken Fehily, Mr. GST. If you ever question the commitment of somebody to their tax specialization, I think Ken's got like a Mr. GST tattooed on his arm that I'm not sure if you'll show us today. So Ken is the director of Fehily Advisory, and he's got over 30 years of experience specializing in complex GST issues, including a lot of margin scheme related consultations. And he actually is on the GST Technical Advisory Committee that developed and wrote the GST laws, or he was. Wrote the GST laws for Australia, and then he still is now a long-time member of the ATO GST Stewardship Group. Everyone, please give a warm round of emoji applause to welcome Ken today. Yay!
Thanks, Vicky, and welcome everybody. Good afternoon. You're probably aware that real property issues are probably the biggest issue for GST, for the tax office, for advisors, for business. It's the area where most errors happen in GST, where most GST is collected, where most problems happen. And interestingly, the margin scheme is where most of it happens. Even though GST has been around for nearly a quarter of a century, we're about to head into the 25th year, there's still issues arising. And already this week, I've given 2 bits of advice to experienced accountants on this. When it comes to margin scheme, Division 75, it's one of the most, I call it, tortuous and complex areas, in the area where most of the legislative amendments have occurred since 2000. My challenge today is to make it as simple as possible, and I feel really confident that by the end of today, and it's not going to take all day, by the end of this hour, you are going to feel much better and much more confident of being able to get through the provisions and being able to apply it or give advice to your clients to apply it. Some of the things we're going to go through, what can it be applied to? And I think you're going to be surprised. What's the definition of real property? I think you're going to be surprised. What does it do? Why did they introduce it to start with? And I could say, well, don't blame me because I didn't write it. Well, sadly, I did. Is it optional or is it automatic? Why did they change it? What was being lost that caused the government to want to change it? The new laws that were changed in 2005 and 2008 and other times, we're going to concentrate on the laws from 2005 onwards and from 2008, and I'm going to explain why. So let's start at the very beginning, because if we don't get you comfortable with the basics, there's no point continuing on. And Vicky, on your behalf, who will see some of the questions coming through, is going to intervene and ask me to repeat some things, because if we don't get the basics right, and a lot of the basics, as I said, I've already had requests for advice this week already from experienced practitioners. The margin scheme, and this is not going to be a lecture. I don't give seminars. I'm going to tell you stories and explain it to you so you feel comfortable in being able to understand it. But I will repeat some of the legislation because when we wrote the law, we tried to write it in simple terms so you don't have to be Mr. GST to be able to explain it, to understand it. The margin scheme, it's interesting they call it a scheme. It's not a tax scheme. It's an arrangement. It applies in working out the amount of GST on a taxable supply. Now, there's some words that you'll see in the legislation where there's an asterisk before it. For example, before a margin scheme, you'll see a little asterisk. You'll see margin scheme in some blue. If it's in blue or there's an asterisk beside it, that means it's defined in the GST law. You have to look up Division 195 in the GST Act, the New Tax System, Goods and Services Tax Act. It was supposed to be a new tax system. You have to look up Division 195 to find out what it means. If you come along to tomorrow's session on how to actually work out the amount, which is where you're actually going to find out how all the savings occur by coming tomorrow, we're going to discuss things like amount, value, and price. Not what you think it means. They're all defined, and that's where all the errors occur. The margin scheme only applies in working out the amount of GST. The amount. That's defined. The amount of GST on our taxable supply. Really critical, but only in a relation where you're selling freehold interest in land, a stratum, a unit, or we call it strata titles, or granting or selling a long-term lease. Not what you think is long-term. That's defined because there's an asterisk behind it or in front of it. means it's expected to last at least 50 years. You might think 20 years is long term. I think it's a long time, but not for GST purposes. Section 75.5, it tells you exactly when you use the margin scheme. That's not enough. It's also in relation to real property. Do you know what real property means? It's defined. Real property is not just mere land and buildings. Real property is defined to include, and as you tax people know, when you use the word includes, that means it's expansive. Real property is what it ordinarily means under common law, but it also includes any interest or right over land, a personal right to call for granted any interest, a license to occupy land. If I just have permission to step on your land, so I'm not trespassing, that's real property. So it can apply to much more than land or buildings. We're going to come back to this. For example, if I have an apartment block and you're about to build an apartment block next to me and it's going to cut out my views over the bay, and I pay to buy out the air rights over your property so you can't build, that's rights in relation to land. That's real property. You might be able to apply the margin scheme. What about in Melbourne? They're building tunnels under the ground and it's making your house shake. Subterranean rights. And you might get compensation for them rattling and shaking your house because they're building underneath your house, under your land. That's real property. It's not just a house or a building. Real property is big. Margin scheme might be able to be used. It's not just land and buildings. What does the margin scheme do? It might not be what you think. Section 75.10 follows 75.5, believe it or not. It's the amount of GST, because amount, actually the word amount is not what you pay for the property, it's not what you cost, it's not what you sell it for. The amount, which we'll come to shortly, 75.10, is the amount of GST that's payable. So when we go through the law later on, we're talking about an amount. The word amount relates to the amount of GST that's payable. The amount of GST, if a taxable supply is under the margin scheme, it's the amount of GST is 1/11 of the margin. Keep that in mind. In fact, I'd like to suggest that if you've got a piece of paper and a pen, start writing down things like price, value, amount, and margin. There are 4 words that we're going to come up all the time, particularly tomorrow when we start discussing the calculation of GST. Amount does not relate to what you paid, what you sell. It's the amount of GST. GST, the amount of GST is the GST payable. That means GST, margin scheme is simply about the amount of GST you pay. That means the application of margin scheme does not mean some of the property is taxable and some of it's GST free. The whole thing is taxable, even though you don't pay tax on the whole amount. So margin scheme, and this is what I'm trying to explain to you, the fundamentals. When you apply margin scheme to a property, real property, it doesn't make some taxable and some not taxable. All the margin scheme does is the amount of GST payable on the entire property. The entire property is taxable, but the margin scheme is a special way to work out the GST or the amount of GST payable on that entire supply, which is entirely taxable. But it's a special way to calculate the amount of GST. Keep this in mind. The whole thing is taxable. It's a totally taxable supply, but the amount of GST is not the normal way you calculate GST. What else does the margin scheme do? Normally, when you make a taxable supply, in the ordinary course of events, you can claim a GST credit. Not with margin scheme. 75/20. Even though the entire supply of a property under the margin scheme is a totally taxable supply, but the amount of GST is less than normal, you can never, ever claim GST credits if you acquired the property where GST was calculated on the margin scheme, even if you want to, even if you're going to use it for making fully taxable supplies. Normally. Why? Because Section 75/20 says you can't. Even if you wanted to, it overrides it. This is how the margin scheme will work. And when we come to an example, and I'll go through it slowly, this is how the margin scheme overall works. GST, totally taxable supply, a totally creditable supply acquisition, but because this is how GST works, GST is the amount of GST is not the normal amount, and you cannot claim a credit. Keep that in mind. You don't pay, the amount of GST is less than normal, and you can never claim it back. This is how it works.
So it definitely doesn't go into your BAS tax credit section.
No. And you might even get a tax invoice which shows the amount taxable, and you might be using the property to make a fully taxable supply. 75/20 says, no, you cannot claim a credit. I'm going to explain now why was it introduced. The reason margin scheme was introduced, and I remember sitting down with John Howard and Peter Costello in 1998, 1999, being told what the policy was. I was told very clearly, we make the policy, you just write the law to make sure that the law works with the policy, we work it out. So it wasn't my idea, we just got to write the law. The broad intention was they wanted to give a concession for the GST payable on the family home, the great Australian dream. We said, why don't you just make it 5%, Mr. Treasurer, Mr. Prime Minister? Oh, no, we can't do that because we're getting rid of the old sales tax that had multiple rates. We have to come up with a better reason. So we came up with the margin scheme. It seemed like a good idea at the time. The real reason was so that the family home would be taxed at an amount less than the full 10%. So rather than 5% or 7% or 2%, they came up with the margin scheme, because margin scheme means the amount of GST payable on a fully taxable new residential premises would be less than normal. And it doesn't matter whether a mom and dad buy the family home or whether an investor buys the family home that rents it to a mom and dad. It makes no difference. It was meant to be for residential premises. That was the broad concept. But that was also going to be combined with other things involving the family home. For example, once the family home is sold the first time, if you look up things like Section 40-65, once residential premises taxed the first time, never taxed again, even if it's within a business. So if you've got a property developer that has a business of renting and buying and selling residential premises, once it's been taxed the first time, never taxed again, even in enterprises. So as part of an overall scheme, hit tax once on residential premises, make it payable under the margin scheme, never taxed again. It was part of an overall scheme intended. However, can it only be used for residential premises? Good question. Of course, it's a good question. I asked it. But the answer is no. Why? It actually can be used for any premises. So, for example, I might buy a home and I want tax to be less. What if I actually want to buy a residential unit to store my boat? What if I want to buy a non-residential unit to store my collection of bikes? What if I want to buy a block of land that's not residential premises to have my kids' ponies on? I can use the margin scheme for any real property. Use the margin. It doesn't just have to be for residential premises. So this presentation today is about eligibility. Remember, we discussed a few slides back, what's the definition of real property? It's an interest over in relation to land and buildings by freehold. So I can buy an empty block of land, a residential premises, and use the margin scheme. I'm eligible, subject to other things which we'll go through soon. It does not just have to be about the family home. It's where a private purchaser wants to buy real property and not use it for business, so wants to pay less than the normal amount of tax, we can use the margin scheme. That's something I think most people listening to today's presentation would probably not be aware of. It's about buying real property and wanting to pay less than the normal amount of tax of GST because we don't get a credit. And that's part of the deal. You pay less tax, can't claim a credit, so let's pay less tax. It doesn't have to be just for residential premises. I think it was worth probably coming to today's presentation just for that alone. But there's more. No steak knives, but more. Is the margin scheme automatic or optional? No. There's an answer. It's optional. It can only apply, we go back to section 75, it only applies if both the recipient, the purchaser, and the supplier, the vendor, both agree in writing that they wish to use the margin scheme. And keeping in mind, it doesn't change the character of the property. It only chooses, it's only an option that if I'm selling and you're buying, we must both agree that we choose to calculate the amount of GST using the margin scheme. Doesn't make it taxable or GST free or input tax. If it's going to be taxable, it's a taxable supply, and we both elect to choose to calculate the amount of GST using the margin scheme. And we must both do that. We must do it in writing. You must do it before the supply occurs. And it's a choice. And if one of us wants to do it and the other doesn't, can't happen. We must both do it. We can't force the other one to do it, and it must be done. Interestingly, if we fail to do it, if we forget to do it, in writing, it doesn't have to be on the contract and sale. It can be in an email. It can be in a separate piece of paper. But it must be in writing. It must be on or before the moment you can actually turn up to settlement and do it 10 seconds before settlement occurs, as long as it's before. Interestingly, though, the commissioner does have the power. There's a PSLA, Practice Statement Law Administration, where the commissioner can give you permission to extend the time, but he doesn't have the discretion to treat it as electing to use the margin scheme. He does have the discretion in certain circumstances to allow me, the vendor, and say you, the purchaser, extra time. So let's say 6 months down the track, we think, oh my, we should have elected to use the margin scheme. We were going to, but we forgot. He can give us both time, say another 6 months, or give us 2 months from when he gives us the permission to go back and both elect. But we still must then elect in writing. And when we do that, it'll be retrospectively applied as though it happened at settlement. Interestingly, we might be able to get stamp duty reductions because the price comes down. The vendor and purchaser, I might say, look, I'm happy to do that. The GST comes down by 50,000, but I want an extra 10,000. So there's a whole bunch of argy-bargy to go on with that. Get a good GST advisor. They'll tell you what to do, depending whether you're the vendor or the purchaser, but you can get permission. Just want to make sure you're aware. If you fail to do that for going concern, which also has to be done before settlement, no discretion to get permission to elect it after settlement. But you can with margin scheme, and the commissioner is normally pretty reasonable, unless there's some avoidance involved. So it's optional, but it must be by both parties, must be in writing. If for some reason you didn't do it in time, the commissioner can give you extra time to do it. If he gives you extra time, but let's say one of the vendors, let's say one of the persons is dead. Let's say it was a company that went insolvent. Let's say if it was a person and they died. He can give you permission to retrospectively elect, but if one of the persons can't do it, then he can't exercise discretion to treat it as having elected. He can only give you extra time. And if
just a quick question on that, is there a prescribed form for you to make that election, or you can just email and say, we elect to use the margin scheme? If you forgot to like tick the box on the contract, for example, to say that you're going to use it.
No, there's no prescribed form. You just write to the
Okay.
but you do have to write to him.
Okay.
And
Yep.
you can't presume. If you've written to him, he must actually, in writing, advise you that he has exercised his discretion, and he will tell you how much time you've got to do it, and then you have to actually do it.
Okay. Yep. You can't just assume that you've sent it off, he'll accept it, and then carry on.
Good, great question. Very good. Now, some people, and I get asked this question regularly, and again, that was part of the question I got asked on Monday. Does the previous property do you have to have purchased the property under the margin scheme to now use the property, to use the margin scheme? No. What it says is if you acquired the property under a taxable supply, under which the margin scheme was not used. But if I sold you a property that was input taxed, or if I was a private vendor and I sold you the property out of scope, it just wasn't subject to you. It was my old family home that I've had for 50 years. You can use the margin scheme. If I sold you out of scope, it wasn't subject to GST. It wasn't a taxable supply. If I sold it to you input tax, it wasn't a taxable supply. You can then use the margin scheme. Some people get confused thinking that I had to have sold it to you under the margin scheme for you to use the margin scheme. The prohibition is if I sold you under as a taxable supply, for you to use the margin scheme, my supply under a taxable supply must have been under the margin scheme. And if you remember what we talked about, selling under the margin scheme is a taxable supply. The only thing margin scheme means is that the GST calculated under a taxable supply changes the method, the amount of GST. It doesn't make it not a taxable supply. That's a question that I get asked tons of times over the last 24 years. A lot of people make mistakes. They say, oh, I bought it and it wasn't under the margin scheme, so I can't use the margin scheme. No, you bought it when it wasn't taxable at all. Therefore, you can use the margin scheme. This comes to the question of eligibility. And we'll go through the legislation. This is section 75. Now, this is the law that applies. This is the law that applied till March 25, and then we're going to go after. And even before March 25 was, you cannot choose to use the margin scheme if you acquired freehold interest, strata title, or long-term lease through a taxable supply on which the GST was worked out without using the margin scheme. So if I sold it to you as input taxed, this doesn't apply. If I sold it to you out of scope, private sale, this doesn't apply. The only time before March 2005 that you couldn't use it is if I sold it to you as a taxable supply that didn't use the margin scheme, you were prohibited. So now you know that. And it's only a little piece of legislation. Have a look. It's one of the first sections in Division 75. Now you know. So you don't have to ring me and pay for advice. How's that? In other words, it's only really can't use it if you paid it, if you bought it as a taxable supply and paid an amount of GST that was full. You can see I'm going to do this step. Now, I'm going to go through a whole bunch of examples to see whether you can get this right. Because I'm not going to ask you, I'm going to ask you the question and then give you the answer. So I'm not going to trick you. Let's say there was a building company that got registered for GST in 2000, but the builder owned the empty block since 1990, built new residential premises after GST came in and sold in 2004. Can that builder elect to use the margin scheme together with the purchaser? And the answer is binary. It's a simple yes or no. The builder, since he bought it or she bought it in 1990, it couldn't have been bought as a taxable supply without using the margin scheme because it was before GST came in? That means the answer is yes. Because it didn't buy it through a taxable supply on which the GST was worked out without applying margin scheme, because it was bought in 1990, wasn't a taxable supply. Answer simple. How about example 2? An individual had a family house since 1950, sold the family home to a second family, also never registered in 2001. When you sell outside the GST regime, not registered, that's called an out-of-scope sale. It's out of the scope of GST. The second family renovated it and sold the family home. Not in the course of carrying on an enterprise, still never GST registered. Sold it to a builder in 2003. Didn't tick the margin scheme box in the sale document, but it was still just a private dealing, but did a big renovation, not constituting a substantial renovation. The builder that bought it in 2003 then demolished the family home completely, knocked it down, even though the second family did a nice renovation, built 5 new townhouses and sold them all to an investor. Can the margin scheme be elected? Taking it step by step, the builder bought the family home from a family in 2003, knocked it down, built 5 brand new residential townhouses, completely different to the house they bought. Can the builder use the margin scheme? Answer is yes or no. The builder bought the house. It wasn't taxable when they bought it. It was an out-of-scope sale. It was also an input tax sale. Didn't buy it as a taxable sale, so answer must be yes. Example 3. And I'm putting some, you can see I'm changing a whole bunch of examples. These are questions I get asked. An investor, registered in 2001, bought an empty block from a farmer. Assume they're registered. Sold the empty block to a builder, also registered in July 2000, under the margin scheme in 2002. The builder then built a huge residential home and sold it to a non-resident family in 2004. Can that builder use the margin scheme? Now, I've purposely used a few confusing things. The GST, the first investor, didn't register till July 2001, not 2000. Sold an empty block to a builder who was registered in July 2000. But the investor sold it under the margin scheme in 2002. If you remember, if we go back to 75.5, you're denied using, so it was a taxable supply. The builder bought it as a taxable supply from the other builder who's registered, but bought it under the margin scheme. And you can't use the margin scheme if you buy land as a taxable supply without using the margin scheme. But in this case, they bought it using the margin scheme. I'm going to show you an example soon. That means they're not prohibited from using the margin scheme now. So the answer is yes. I'm going to show you multiple supplies in a moment. We're going to take our time at this initial part of the seminar, presentation, webinar, giving you little nuggets of advice and getting it right. Now, example 4. Investor didn't register to July about an empty block in 2000. And by the way, distinguish between, we'll do this tomorrow, massive difference between getting a valuation at 30 June 2000 and getting a valuation at July 1, 2000. One's valid for GST purposes and one's not. Huge difference. Sold the empty block to a builder, plus full 10% GST in 2002. Builder built new residential premises and sold. Now, I didn't say whether the builder buying it for 10% GST, whether the builder claimed GST back or not, would have got a tax invoice plus 10% GST because the next builder built new residential premises to sell to an investor, was entitled to claim GST back as a credit. It makes absolutely no difference whether he claimed it or didn't claim it, which is why I didn't put it in the example. It's irrelevant. Then sold new residential premises and sold to an investor. And remember I said at the beginning, it didn't matter whether the family home sold to a mom and dad or to an investor. The concession still supposed to apply. Can the margin scheme be elected? You're prohibited from using the margin scheme if you buy it under a taxable supply and the margin scheme was not used to determine the amount of GST. And even though the margin scheme could have been elected, it wasn't. And even though GST could be claimed, whether it did or not, 75.5 prohibits the new builder from using the margin scheme. Silly him. No, can't use the margin scheme. Probably could have. They thought of it all the way back. Maybe the builder was thinking of actually building industrial premises, so bought it at 10%, claimed the GST back, didn't think of building it, and then changed his mind and built resident. There's all kinds of reasons. Maybe it wasn't a mistake, but probably too late. Okay, now I'm going to explain how this can work over a period of time. I'm going to take my time. Investor 1 held the property at 1 July 2000. Since the investor held the property at 1 July 2000, we have to presume that they bought it sometime before, which means they bought it when there was no GST in existence. Investor 1 sells it to Investor 2 for $300,000 plus $10,000 GST under the margin scheme. Since it was worth $200,000 on 1 July and sold it 2 years later for $300,000, the margin was $100,000. Sold for $300,000, it was worth $200,000. The margin is $100,000. The GST on the margin is $10,000, so he sells it for $300,000 plus the $10,000 GST equals $310,000. So when you think about it, between 1 July 2000 and 1 July 2002, the margin, the difference is $100,000. Add 10%, sell it for $310,000. Tax office gets the $10,000, can't claim it back. Tax office now has 1/11 of the margin, 200 to 310, gets 1/11, keeps it. Assuming nothing's built on it yet, it's just increased in value. A year later, that investor sells it to another investor for $310,000 plus $100,000 to $410. Another $100,000 has been added. Add another $10,000 GST. Now, the total increase in value is $200,000 plus the GST, another $10,000. Sends that to the tax office, can't claim it back. This is multiple margins. So you see, the tax office wants every time a margin is added, you have to keep paying GST on each margin, and nobody can claim it back. It's cumulative. And that's why GST can continue. The margin scheme, even though it's 24 years since it came in, it still works. And not every bit of land that was existed in 2000 has been finally built and sold for the first time. This can work for 50 years. We're already a quarter of a century, it can work for half a century. So now what we've got is, I'll go back. Now, started at 200,000. It's now worth 500,000, 300,000 margin, plus the GST on the margins of 300,000 plus 10% GST on the 300,000 is 30. It's now worth 530. Tax office has got 3 licks of 10,000 each time, 530,000. Tax office has got the 30,000, gives none of it back. Property is now 200,000 plus the 300 margin, plus the 30,000 GST on the 300 plus 530. Tax office has got 330,000 in its midst, hasn't given any back. That's how the margin scheme works. The margin keeps building until eventually somebody's going to build a house on it. The GST is going to capture by the tax office, and then it stops. That's how margin scheme works. It doesn't have to be a house. As I said, it can be industrial property. It can be a block of land for the kids' horsey and ponies. That's how it works. It's actually kind of makes a lot of sense. If you do it on a piece of paper, do it on a whiteboard, it actually works. I'm trying to explain that, and this is for eligibility. But at some point, you cease to be eligible, and then it stops. So even though it could work for 50 years, once you cease to be eligible, and that's what I'm going to spend the rest of this presentation on. But what happened? You saw the way those margins work, because each time somebody is entitled to use the margin scheme, then they use the margin scheme, and they were entitled to use the margin scheme. What happened? Now, I was on the panel that wrote the law. We didn't realize. We forgot. We were in a rush. We didn't realize that sometimes things happen that gives an unintended result. So, for example, sometimes something happens before the house is built. What I might do is go straight to an example. Let's say a developer bought an empty block in June 2000 before GST came in. Look carefully when I write June 2000 versus July. June is before GST came in. So before GST started, this block of land was worth $2 million. Started developing, say I'm the developer, and I sold the development halfway through to another developer for $9 million as a GST-free going concern. A margin of $7 million. But it was GST-free as a going concern. No GST got collected on that margin. Because the law was written that we gave the person a choice. You don't have to pay GST on that margin. Then the next developer completed the margin in 2005, a year later, sold it for $15 million under the margin scheme. Paid, so that developer made a $6 million margin, bought it for $9 million, sold it for $15 million, made a margin of $6 million. That means only would have paid GST on the margin of $6 million. But what about the first margin? Worth $2 million at 2000, worth $9 million. The tax office, the government, was missing out on GST on the first $7 million margin. Let's look at the next slide. See? No GST got picked up on the first margin. We didn't realize, we didn't intend. It was a mistake.
That was an unanticipated and unacceptable loss.
So, due to a whole bunch of politics, then we worked out that wasn't just going concern. What about farmland? What about buying from associates? What about inherited property? Then what about all kinds of things? Then there was a whole mass of issues. In 2005, we thought, well, how are we going to pick up the GST on the previous margin? Whoa, when I say we, I'm talking about government. Well, they could make easy. What you do is you get the person paying the tax on the $6 million and make that person pay GST on the previous person's margin of $7 million. It could actually work out that the GST is more than the whole profit margin. Really?
Yeah.
Wow.
Is that a bit mean?
That's a bit mean. That's why it took years to change the law, and it was done in 2 steps, 2005 and 2000. You can't make someone pay GST on someone else's profit. No, that's not very nice. How else is the government going to recoup it? So now I'm going to start quickly running through eligibility law. I got bad news for all of you. They're excruciatingly complex. The only way you're going to get to the answer is to go through the steps one by one, and that's what I'm going to take you through now. If you ask me the question, I would actually have to go through this legislation step by step. There is no other way to do it. I'm sorry, it's complex, but I'm going to show you it's actually not that hard. I have confidence that everybody watching this, you can do it. Yes, you can do it. Okay? Now that you know the basics, I'm going to show you how to do it, and you will be able to do it. It looks massively complicated because it is, but I'm sure you can do it. So now we're looking at the laws from 17 March 2005. We start here. Section 75.5, so this is now subsection 2, as from 17 March 2005, does not apply if you acquired the freehold or strata title where it was ineligible. It's kind of the same as the old 75.2. We know that. If you buy a taxable supply, that wasn't the margin scheme. But then we've now got a supply is ineligible if it's a taxable supply that was worked out without the margin scheme. We kind of know that one already. And then we also introduced, government, I was involved in this, a supply that you acquire from inheriting from somebody. And that person acquired it through a taxable supply. That wasn't used the margin scheme. This is just putting the toe in the water. This is 17 March 2005. The government's still working out how do we get the rest of them, making somebody pay tax on someone else's margin. They weren't ready yet. So this is 2005. They then also worked out that what if you're buying from a group and you've elected to go into the group? Well, what they did was, and let me take you through this slowly, you've chosen to group a bunch of companies. And you're buying from a member of a group, and the member from a group bought from another member of a group, and that member of the group bought it from somebody who wasn't eligible. So you think, sneaky, what I'll do is I'll group all those companies and I'll buy it from a member of a group that didn't buy it from anyone else because you ignore it for grouping purposes. Tax office caught on to that and thought, you chose to group so you could ignore the purchase from the other group member, but if you bought it from the original group member that bought from outside the group, you would have been ineligible. So you group them all so you could actually refresh it. No, we're not going to allow that. So from 17 March, if you bought it from a group and the original member of the group that bought it from an outsider wasn't eligible, then you're not going to be allowed to use the margin scheme at all. We're on to you.
Nice try.
You got sprung from 17 March. But there were so many more. Now, in December 2008, the government got the guts and decided to do a whole bunch of other changes. Now, it introduced Section 75.5.3, which started to talk about, did I miss a slide about multiple? No. Okay. I'm just the slide, multiple. Okay, so what they did was, sorry, I missed the slide. So what they did was they introduced, in 9 December, they introduced new laws, and you won't find this just in the normal book. You got to go back to the introductory sections, which are really hard to find because you got to find the laws, like the Tax Law Amendment Act. So some of them, let me just find this. So I should have done this. Some of the supplies, you have to go back to the previous supply. So if I'm selling to you, So just bear with me for a moment. The new laws in 2005, in some of the laws, what they did was, and particularly in 2008, instead of working out whether I'm entitled to use the law, you have to go back to the person I bought it from.
So you have to trace through, like trace back.
And,
yeah.
And people say, that's ridiculous. I said, okay.
Yeah.
It's ridiculous, but that's what the law says. And when people ask me, I say, well, you want to use the margin scheme, or you want to use the margin scheme, you have to now go back to find out the person that you bought it from and work out how they bought it. And they say, well, that's probably 20 years ago. I said, yeah, that's what the law says. You have to go back to find out how that person bought it to see whether by that person buying in a particular way, because that person wasn't entitled to, and they sold it to you in a particular way to refresh your ability to use it, you can't use it. And they say, you got to be kidding. I said, no, wait till then, if you get past that, wait till then try to work out the amount of GST, because even if you are eligible, then you might have to include their margin. So the first thing is to work out whether you're eligible, which is what we're covering today. So sometimes you have to go back to the previous transaction prior to your sale.
Yeah, so there's I think there's a few questions in the Q&A about this as well, but just time checking you, Ken, there's 5 minutes left.
Okay, so let me go through this, because I can't go through you have to look at 7553. A supply is ineligible for the margin scheme if it's a taxable supply. So if I'm about to use the margin scheme, if it's a taxable supply that was worked out without applying the margin scheme, or a supply that I acquire from inheriting, then it goes on to a member of a group. And then what it does, they introduce from December 2008, the amendment applies in relation to supplies that are supplies that I, the supplier, acquired from another person after 9 December 2008. You've got to understand what it's talking about is a new supply. So if I'm making a supply, and it's a supply of a thing that's a new supply, we're going to go through this in the next few minutes. I'm making a supply of a thing of property that's a new supply, and the definition of new supply is a supply that is actually a purchase I made after 9 December 2008 from another person after 9 December 2008. Now I'm going to do it again. If I'm making a supply, that's a supply that I acquired, which is a purchase from another person after 9 December 2008, and it talks about there's some grandfathering, unless it was a supply that by 9 December there was a contract that fixed the price. You're going to have to go through this. If I'm supplying something today, and it was something that I acquired after 9 December 2008, and the only way we can work that out is if I actually work out my previous supply. That's the only way. When somebody asks me, can I use this supply? Can I make the supply of this under the margin scheme? I'm going to say, when did you buy it? Did you buy it after 9 December 2008? Why are you asking me that? Because I can't tell you whether you can use the margin scheme unless you can tell me if you bought it before 9 December 2008, you can. If you bought it after 9 December 2008, then you have to go to this. And then what happens is, then you have to start going through section 7553. What did you buy it through a joint venture? Then you got all that. And then did you buy it from an associate? Did you buy it from an associate? See, what actually happens is you have to go through each of these sections one by one. D, did you buy it through a joint venture or a joint venture operator? E, did you buy it through all these provisions? You have to go through step by step. That's what I have to do. I'm going to go through that again. If I'm about to make a supply under a margin scheme, the first question I ask the person is, when did you buy it? If I bought it before 9 December 2008, first question, did I buy it under a margin scheme or taxable supply? The normal question. If I get through that, but if I bought it after 9 December 2000, I said, I'm going to make this simple for you. I'm asking you a really simple question. If I'm going to sell it, I ask them, did I buy it on or after 9 December 2008? I know I'm being maybe a bit rude because I can't give you the answer until you tell me that. And if this person bought it after 9 December, then you're going to have to go back and find out how that person bought it. Did they inherit it? Did they buy it through a group? Did they buy it? Did they inherit it? Did they buy it through a joint venture participant? Did they buy it through a joint venture operator? And the reason I said all those things out, because the questions are all different. And only then can I tell them whether they're eligible to use the margin scheme. I'm sorry, I said it's complex, but it's simple. The question's simple. When did you buy it? Did you buy it under taxable supply in which the margin scheme was used? And was it before 8 December 2008? And if you did, there's the list you have to go through. And you have to find the answer. Because if you ask me, as Mr. GST that wrote the law, that's all I advise on. I have to go back to that list and look up the requirements step by step. It's the only way you can do it. That's the answer.
Yeah. Actually, the legislation set out quite clearly, I think, because I've looked at it. It looks a bit messy on the slides, but when you go through it like step by step, it's quite like
it's the only way. So if somebody wants to ask me a question, I'm going to ask you the question, did you buy it under a taxable supply on which the margin scheme was used? Yes. Then, did you buy it before or after December 2008? And if it was before, I'm going to go through all the next slides. And if you want, I can charge you by the hour for doing that, or you can do it yourself. It's the same answer. There's no shortcut. I'm telling you the truth. I'm giving away all my secrets. There is no other way to do it. And tomorrow, we're going to go through the same thing when it comes to when you get to the answer, if you are eligible, then we're going to spend 15 minutes on 4 words: amount, value, price,
and margin.
Sorry, I think I'm about to lose power.
Oh, good. While you're plugging that in, we will launch today's feedback poll. Just to give us any insight, feel free to give us your ratings and any comment suggestions for next time as well, including any further topic suggestions if you want. But it is 1:30 now, Ken, if you would like to wrap up quickly. I think we are at the end, though. Yeah.
So I think, the answers, you have to go through this process. It's the only way to do it. I wish I could have made it simpler, but I'm 24 years too late.
It's all right. When is tax ever simple? It's fine. We forgive you, Ken. Awesome. Yep. Did you want to move to the next slides? We'll just give a quick shout out about your newsletter. So there is a link in the slide pack if anyone wants to Subscribe to Ken Talks GST newsletter, just some thought leadership and some interesting comments as well on what's happening recently in GST. And also, if anyone's enjoyed this webinar and you want to suss out Tax Nuggets Academy a little bit more, we've got another link there as well in the slide pack, or as well you can Google, everyone capable of Googling Tax Nuggets Academy. You can check out our plans and pricing. And remember, today's session is being recorded, and it is available for our VIP and team subscribers only, so you can get a free trial of the VIP subscription just to take a look at what we've got. We've got a couple of questions that I will be quite selective with because a few of them deal with the calculation aspect, which we will be going through tomorrow. So that is actually a subscriber only event. And like Ken and I were talking about this before, but that is where the value add, the how to make money session, all those secrets will be happening tomorrow. So today was just eligibility. So Ken, do you just have a couple more minutes? I'll just take a few questions, not too many. Just the ones related.
I don't know why my battery's running out, but we'll have to be quick.
Okay, that's okay. So first question is from Timothy. This is about the multiple margins, I think, example that we went through. So where investor 1 sells the property under the margin scheme to investor number 2 for the 200 plus 200 plus 100 plus 10,000 margin, can investor 2 claim the 10K as tax credits in their BAS?
No.
Or if not, what happens to it? Is it ever claimable by them?
Never. That was one of the first slides we did. You can never, ever claim GST back. One of the very first slides, you can never claim GST back where it's taxed under the margin scheme. Never.
Yeah. Never ever.
Which slide it is, if you look through the multiple examples, GST is never claimed back, and I think it's 7510. You cannot claim GST back where it's paid under the margin scheme. Never.
Yeah, never. It's just gone to the ATO and then they've just...
Otherwise, it doesn't work.
Yeah.
Even though it's a taxable supply and it's used for creditable purposes, you can never claim GST back. The GST has been calculated under the margin scheme. Never.
Yeah.
First,
cool. And then
there's a special provision where you buy 2 blocks of land, one under the margin scheme, one not in the margin scheme, and you want to use the margin scheme, you still can't claim it back, but there's a mechanism called amalgamated land where you actually pay an amount.
Okay.
It's a complicated thing, but you still can't claim the GST back on the margin scheme. Never.
Okay.
Ever.
That amalgamated land thing is a bit of a pay-to-play sort of thing then. Yeah. Cool. And then on the other side then, if you can't claim the input tax credits, how would you report the whole amount of the sale for the consideration you receive from a sale of a property under the margin scheme in your BAS?
No, because if you go back to the slide, the multiple sale,
yep. Mm-hmm.
Every time you add a margin, you only pay GST on the extra. The tax office only paid on the previous amount.
Oh no, this is the disclosure of the sales amount in the business activity statement. So, for example, if that last person was the developer,
GST is payable on the amount, which is the value. The GST is payable on the margin.
Yeah.
So when we got to the end, GST paid on the first 530,000 on that example.
Yeah.
Right.
So I think the question was asking whether investor 3 needs to include 530,000 in the sales amount.
I'm answering the question. It's already paid on 530,000. If it's then for 830,000, the margin is another 300,000. That's the value. That's the amount GST. You only declare 300,000, the extra margin.
Okay, so that's the only amount you would report under the sales.
The GST is paid on the margin, not on the full sum. The margin scheme. You pay tax on the margin. That's all in those first examples, the very basics we went through. You pay tax on the margin, which is the difference between the price, the selling price, and the base. That's all going to be covered tomorrow. But I thought I'd give an example today.
Yeah.
Each time you sell under the margin scheme, GST is captured on the margin, and then you start from that point, and you pay tax on the next margin. But you never pay tax on what's already been taxed.
Mm-hmm. Yeah.
Look at that example. Follow the example bit by bit. GST was never paid on the previous amount. It's always only paid on the extra margin. You pull that slide up again? Actually, I can go.
Cool. You can,
And I'll go back to it.
I don't know if you've got your mouse, if you hover over the bottom left, there might be like a little.
Here we go.
Yeah.
So, Yester 3 bought it for 520. Bought it for 420 from the previous person. Sold it for 520 plus GST. Only paid tax 10%. 10% of the 100,000. Didn't pay tax on the GST had already been paid on 420. Sold it for 520 plus GST. Only paid tax on the margin of 100,000 he added. Now he's paid 530. Now it's already been sold for 530,000. If it was then sold for 830,000, GST would be payable on 830 less 530 is 300,000. GST has already been collected on the first 530,000.
Yeah, but I think the question was actually on reporting label G1 on total sales. Do you include the 530 or just the margin?
No, pay tax on the margin. You declare the margin. So each of these people would have declared 100,000.
Yeah.
GST inclusive would be 110,000.
Yeah. I'm assuming from the BAS instructions though, Michael, that you declare the whole 530, but when you complete your BAS, your actual GST amount is on the margin.
No. You declare. That's why tomorrow we're going to go through value.
Yep.
The amount on which GST is payable is the value. That's the margin.
Yep.
When you sell something for 100,000 plus 10,000, normally the value that you pay tax on is either 100 or 110,000, including GST.
Yep.
When you're doing it on the margin scheme, the value is the margin, not the selling price.
Yep.
It's different.
Yep. Understand, but I think Michael's asking something else. I'll email you after this just to clarify it.
No, the issue is,
yep,
you don't declare the entire selling price. That's already been declared in previous BASs by different people. GST under the margin scheme is you declare margin.
Okay.
Margin.
Yep. So you only declare margin in the little sales label in your BAS then.
Yeah, absolutely.
Okay. Yep. Hope that answers your question, Michael. I think I was getting confused as well.
Margin.
Then.
It's called a margin scheme.
Yeah. Okay.
The only thing that's called
that answers
the margin.
Yeah. Okay. Moving on.
Go back.
Oh no, there's a lot of. Everyone's asking the same question.
But this is all calculation, which is tomorrow. Today's
calculation tomorrow. Yeah.
We're going into tomorrow's presentation.
Yep. Okay, cool. Then just one last question then, just to clarify with the whole tracing back thing. But also this is to do with eligibility. This question's from Amanda. So she is saying if an investor...
The taxable supply, property, the taxable supply is on the margin.
Oops, something happened. Our slides disappeared.
It's on the supply. It's different.
Oh, there we go. Back. Okay, cool. Yep, sorry, just one more question. If an investor buys a commercial shared, even if they're purchasing it from a GST registered seller, if the margin scheme has been used at some point, then no GST input credits will be available to the purchaser now. Is that correct?
So say that again.
So an investor has bought a commercial shed or building, even if they are purchasing it from a GST registered seller, if at some point the margin scheme has been used in the past, then does that mean that there is no GST input credits that will be available to the purchaser now?
Okay, well, we can't, the question has to be more defined. We can't say sometime in the past. If an investor, right, sales back in 1920, if an investor has a property in which they acquired the property under a taxable supply in which the margin scheme was not used, they can't use the margin scheme.
Mm-hmm. Okay. So
Can't
it's
use
all
it.
about, you got to get more facts on that.
So if the previous sale, so if an investor has a property that they own, or you have to go back to one of the examples. Let's say an investor had a property in 1995, which means it wasn't bought under the taxable supply. Now about to make the first supply, and it's to an individual that wants to buy it for personal purposes. So the investor has the property, hasn't bought it previously under a taxable supply on which the margin scheme was used. I'm sorry, on which tax was paid on the full amount because they bought it before GST came in. Can they use the margin scheme? Yes. The investor bought it after 1 July under a taxable supply, and they did not use the margin scheme, so they bought it including full GST. Now wants to sell it to an individual that wants to use the margin scheme. Can they use margin scheme? No. Because the investor bought it under a taxable supply under which the margin scheme was not used.
Yeah.
The question was, if they bought it any past sale, well, that's not a question. That's kind of, which one are they talking about?
Okay. Understand. All right. We'll wrap it up there because we're running a bit over time. We don't want your laptop to die as well, Ken. Thank you so much for your time. Yep.
So no, an investor that bought it under a taxable supply in which the mark was used, yes, they are eligible to sell it under the margin scheme. If the investor bought it before GST and wants to sell it under the margin scheme, yes, they can. If the investor bought it as a taxable supply in which the margin scheme was used, can they use the margin scheme? Yes. Go through the 5 examples. Go through the 4 examples. All those questions are answered in the 4 examples.
Yep. Perfect. And if everything else fails, go back to the legislation. All right. Thank you. We're running out of time. Thank you so much, Ken. Thank you, everyone else, for hanging around and participating and asking your questions. We'll be back tomorrow with more detailed stuff on the calculation aspect of the margin scheme. As everyone knows, it's quite complicated, but hopefully we'll uncomplicate it for you all today and tomorrow. All right. Thanks, everyone. Thanks, Ken. We'll see you tomorrow.
Pleasure.